Okay, good afternoon, everybody. It's 12 o'clock, so we'll get started. Expecting a couple others to join in here shortly, but I want to be respectful of everyone's time. So welcome to our referendum rundown. My name is John Major. I'm the Registered Municipal Advisor Principal here at ADM. Working with the majority of our school district clients on managing their bond proceeds, and going to cover quite a few items today quickly, and focusing mostly on the pieces of the puzzle after you actually issue your debt. So we'll touch on just a little bit the pre-issuance items that will still remain for you, and then dive into the meat of the things to consider once you pass your referendum and once you issue your bonds. So I will try to get to my presenter mode here. So 5 key components that we'll be talking about today: underwriting, legal requirements, those are primarily pre-issuance, and then the meat of it, bond proceeds management, what you do after you issue your debt, arbitrage rebate tracking, what you're doing after you issue your debt, and then the importance of paying agents and making sure you have someone watching your payments for your debt. So in your assumptions that you have probably already seen from your financial consultants, but definitely we'll be looking at in a very great detail as you come to finalize your plan of finance, your current levy and growth in your tax base, state aid contribution, your bond rating if you do have one, or what your bond rating might be if you don't have one, and interest rates and the market at large and what's happening there and how that can affect the cost of your issuance. Quickly on the market, we have seen rates come up from lower levels of the last few years, but really slightly elevated based on the last 10 years. But in the grand scheme of things, you know, the 50-year history rates are still relatively low. So good value for the borrowings that you're doing now. And another touch on bond ratings. So these are Wisconsin school districts, the numbers that we have at every level, and obviously very highly rated, but not very many that are AAA rated. So there are definitely issues, but granted small most of the time. And it is important because this really comes down to dollars and cents. How much are your bonds going to cost you? How much is your project going to cost you and your taxpayers? If you are a notch higher, you can be looking at something like 10 basis points or 0.10% difference in borrowing costs, which can equate to upwards of $100,000 on a $10 million borrowing. So the higher rating is better, obviously, but it really comes down to dollars and cents. And then this is what goes into those ratings. This is from Moody's, but the other services have similar inputs, and the 4 main inputs being economy, leverage, financial performance, and the institutional framework. So what do your local residents make in income, and are they having kids? Are your enrollment trends going up or down? Leverage, what is your existing debt? What's the existing debt around you and in your other overlapping entities? And of course, costs. And then financial performance, fund balance ratio and cash ratio. How much do you have? How much are you able to save compared to what you're bringing in? And the institutional framework, what does your management and leadership look like? And really, what is the direction that you're going? Some notching factors, so to speak, on the right-hand side there. Small adjustments, but adjustments nonetheless for the better or worse, depending on your situation. And then that's where you get the final rating, and that will determine what folks are willing to pay for your bonds and what they will require in interest or return to them in order to invest in those bonds. So when you're developing your final plan of finance, of course, you want to stay below your proposed tax increase, tax impact, maybe not an increase, minimize your total interest costs, and minimize your interest rate risk. So depending on your structure, you may be borrowing now and in the future, but you want to minimize the amount of impact a market change can have on your cost on those future borrowings. And of course, maximize your interest earnings, investment earnings on those funds during the project, which we'll talk about in a little bit. So strategies, flexibility with market timing. You may be looking at a bond anticipation note to get your dollars sooner and be able to start work on your project, but then have the flexibility to issue the general obligation bonds later when it's more advantageous to be in the market. Also, you may be considering splitting borrowing into 2 calendar years. This can have arbitrage considerations, which we'll also talk about in a minute, but also levy implications and cost implications based on the market and what rates are doing. And of course, you want to begin as soon as possible. Most everyone on this call is likely already at that point and maybe is getting tired of preparation, but the more you have ready to go once you get that big yes vote, you can hit the ground running and not have a lot of delay in making the next steps happen. So your timeline of legal requirements, now we're coming to the middle of this line, past the first notice, coming up on the second notice, and third notice. This is state of Wisconsin, I should say specifically, right before Election Day, and April 1st being D-Day, and then April 8th, Board of Canvassers need to meet and report the results back to the Department of Public Instruction within 10 days. And all of these requirements are to ensure that the validity of the results are not questioned so that you can issue your debt and also maintain your tax-exempt status. When you get to these points, you're working with bond counsel, and you do need a bond counsel opinion to get that tax-exempt status. This has been a requirement for 100 years, and those professionals will give you the legal verification that those bonds are issued under or in compliance with state law, and you do have that tax-exempt status, which of course affects the price, the rate that you have to pay, and changes drastically and not for the better if you don't have it. So what can you do and what can you not do with district funds in this process? You can make expenditures for public purpose, and you can inform the voters of the facts of the situation. What you cannot do is expressly advocate for a particular outcome, and you can't use district computers or technologies to expressly advocate or promote a particular outcome. So very careful with that. Most of you are probably well aware of that, but reminders as we get to the end, and you may have some debates, healthy debates / arguments on what the right path is for your district. So staying on track, you likely already have bond counsel engaged, but work closely with them and your other partners to keep track of your timelines, pay attention to publication dates and other steps that they are advising. And of course, don't hesitate to ask questions. If you've not done this process before or haven't done it in a while, you never want to just assume, and always ask the questions so you make sure you stay on track. So hey, congrats. You passed, got that big yes vote. Now what do you do? We're going to talk about making the most of this cash because unlike borrowing money for a lot of other construction projects in this world, you get all your money on one day or the majority of it on one day, and then you have a long runway before that gets spent down. So we'll talk about how and why rates move. Got a hint there for you. It is mostly the Fed and their actions, and then people in the markets' reactions to that. A sense of where we have been and where we might go. Of course, back in the 80s, rates were very high, and we've really slowly been trending down a long time of ultra low interest rates, as we would say, and then started to go back in the right direction or normalizing before COVID hit. And now we've really come back to a much more normal situation where Fed funds rates are in the 4% range, and it looks more like it has throughout history as opposed to almost nothing for the last 10 years. So what are your options? Once you receive this big pot of money and you know you're not going to spend it for a while, we want to keep it simple, and you don't have a lot of options. You can't buy Bitcoin or Tesla stock, but there are things you can do to maximize these funds. And especially when you're talking about 10 million or 20 million or $50 million over the course of a couple-year project, it can really add up and add to the project in providing additional income. So we always say failing to plan is planning to fail. Number one, check your investment policy. If the district has something different than the state statutes, you want to either adjust that or be aware of that so you're not out of compliance with your own policy. Determine your risk tolerance. So this goes along with the policy. If your district has historically been extra conservative and only wanted to work with, say, banks within your county, no securities, no government investment pool, that may have worked in the past. It might work for your regular banking, but it might be prohibitively restrictive for these types of funds that are large dollar amounts held for longer periods of time. And then once you have your policy in place, then you need a plan. So we want to execute a plan based on your specific cash flow needs, and as opposed to just holding cash and hoping rates stay the same or go up. We want to be more strategic. And here's a list of your options. Again, very safe and secure investments. These are your constituents' dollars, after all, going for the benefit of your community and the future. U.S. Treasuries and agencies. So explicitly backed by the U.S. government, the Treasuries are. Government agencies are implicitly backed. So they don't have a direct guarantee from the government, but it is everything but that. And we've seen that in the past. So they're very highly rated. They're very safe, very liquid. Also, the market is huge, so you can buy and sell them at any time. But generally, these are the lowest paying options that you have because they're so safe, because they're so liquid. They don't require a higher rate. Banks, on the other hand, if you're looking at bank products, which would be your traditional CDs, repurchase agreements, or other collateralization that can provide security on cash that is held at a single institution above and beyond the federal government's FDIC insurance. Those you might get a little bit higher return on, but they don't have that direct government backing. And sometimes there are other restrictions from the bank as opposed to just being able to go out and sell those in the open market. So they generally have a slightly higher return. And then commercial paper would be the next step up with higher risk and higher return. These are unsecured loans to major corporations. So think Coca-Cola, Apple, et cetera. You're not borrowing for a long time. You don't think that Apple is just going to disappear in the next 3 months. So you're willing to take that risk and not have any security, but you get compensated for that with a higher return. And the other option is taxable or tax-exempt securities. You can buy municipal bonds just like the bonds that you are issuing into the market. This is generally not advisable because your return will be lower. However, there are implications for arbitrage that we'll talk about in a minute, and there are opportunities depending on your situation that might make that a valuable option for you. So all of these investments are going to fluctuate in value daily, except a bank product. So you have the opportunity to sell for a profit potentially if the market changes and the value goes up. You can also lose principal if you sell at a discount if the market goes down. So we always want to balance the liquidity with the yield. You want to have enough liquidity that you have flexibility, but are maximizing yield. But we don't want to maximize yield at the detriment of the flexibility that you may need in a large project like you're about to look at. So where are rates headed? Nobody really knows, and anyone says that they do is lying. But rates are probably still going down, although the inflation numbers that came out yesterday may change some people's minds on that. This is the infamous Treasury yield curve from a few days back, but gives you a sense of that blue line where rates were last year, lower than they are today across the board. Last month, they were higher. So the expectation of the market was that rates were going to go up over time. And that is still the expectation, but it's been tempered. So rates have come up on the shorter end. You can see 1 month through 1 year, give or take, rates are higher. But in the middle there, they have come down. So the market is telling us that they think that rates will go down in the sort of intermediate term, 1, 2, 3 years from now, but that over the long term, they will continue to go back up. So this is a little bit of reading the tea leaves, but you can see from the history that folks thought that rates needed to go up. Now they think rates need to go down a little bit in response to what's happening in the economy. And the inflation number yesterday was above expectations. The economy maybe being running a little hotter than the Fed would like. So they may choose to hold rates or even increase rates based on that. But the market says that that's not going to happen, that this is a bit of a blip, and in that short to mediate term, rates will still trend down slightly, however. A couple other points on the Fed. This is the Fed Watch tool from the CME group based on the futures markets and giving us probabilities of the next cut. So the next Fed meeting, March 19th, the recent meeting this month, they made no change. The current target rate is 425 to 450. 2 days ago, before the inflation number, 86% chance that rates would stay the same next month, and yesterday, 97.5%. So again, that inflation number telling people they think that the Fed will hold and not lower rates, trying to boost economic performance. Same thing happened for the May meeting, 65% chance rates stay the same. Now it's 86% chance. And then the June meeting, even still, was a much larger spread. Now we're looking at 67% chance rates stay the same, and a roughly 30% chance that they go down only by a quarter point. So that's what's happening in the market. And now we'll talk about arbitrage, which dovetails nicely because what you earn and if rates stay the same versus what you're borrowing at the rate that you're borrowing at is really what arbitrage is all about. So the investment earnings that you are able to earn is what your bonds cost you, or your bond yield, the aggregate bond yield for all of the pieces of your issue, and what you are earning over time on your outstanding bond proceeds. So positive arbitrage means your actual earnings are greater than your bond yield earnings. That's the part that needs to go back to the IRS. Negative arbitrage would be the opposite. If you've earned less than that, then there's really nothing you have to worry about. But these calculations should be performed at least every 5 years while proceeds are outstanding. We definitely advise doing it more often, especially in a market like we're in right now, where you're likely going to issue at a very similar rate to what you're going to be able to invest at. And over the course of your project, very likely that your investment rates could exceed your borrowing rates. Big issue here, that last point, if you fail to comply with these requirements, you could lose your tax exempt status, which probably don't need to tell you is a very bad thing if you're trying to borrow in the public market. So we really want to avoid that. And the reason that these rules exist is really to protect that tax exempt status. They don't want borrowers of tax exempt debt, school districts or municipalities or whomever, to be able to have a profit motive for borrowing more than they need, having it outstanding for longer than is necessary, or borrowing earlier than is necessary for their particular project. So they want you to match the duration with your project, borrow what you need, and they're happy to provide a bit of a discount by being tax exempt. But if you're going to try and make a profit off of that status, then they don't want you to have that status. So we have arbitrage rebate, yield restrictions. There's some overlapping requirements, but these apply to every tax exempt borrowing. If you are familiar or had a smaller borrowing in the past, there are exemptions. Those exemptions work for a period, but as we'll talk about in a second, after your temporary period, there are still other rules to follow. So if you have general obligation, revenue, notes, leases, commercial paper, installment financing, all of these are under the arbitrage rebate rules. Compliance due at least every 5 years while proceeds are outstanding, or within 60 days, you need to make a payment once your proceeds are fully spent. Yield restriction is beyond 3 years or beyond your initial temporary period. Most issues are 3 years, they can be 5, but that applies, yield restriction applies even if you are a small issuer. So if you've had outstanding debt, or if you do have outstanding proceeds, I should say, beyond 3 years for any reason, even if you were exempt before, you're no longer exempt, and yield restriction rules apply. All of these funds would be subject to arbitrage, cost of issuance, construction, escrow, debt service reserves, debt service funds, and proceeds from refunded issues. Those are all included in the calculations. And this is the small issuer exemption. We see a lot of this with school districts. Really, the key is $15 million or less per year, per calendar year. So you can borrow $15 million in 2025, $15 million in 2026, and not have to worry about the arbitrage rules until you go beyond 3 years. If you still have proceeds outstanding beyond 3 years, then you will have that yield restriction calculation, and that's a different ball of wax. Other spending exceptions, so you can avoid arbitrage if you hit these spending targets. Spend all of your proceeds within 6 months, spend them all within 18 months, but hit 15, 60, and 100% by those dates, and 2 years, same thing, 100% within 24 months, but you have to hit those targets in between as well. Otherwise, you are not exempt. Yield restriction one more time. So 3 years on construction funds, and payments are due 60 days after the computation date, typically after the proceeds are fully spent. You do have, if you have outstanding proceeds, you get an extra 1/8 of a percentage point above your bond yield, so 0.125% that you can earn without having to pay the yield restriction. Anything above that is yield restriction, and that portion would go back to the IRS. A great example in the last couple of years, this has really come back to rear its ugly head with some districts that borrowed at very low rates and even invested at very low rates, but then whether their project was delayed or they had investment earnings that were not able to be spent on project-related costs, suddenly you borrowed at 2 or 3%, and now you're earning 5% on those funds. So if we go beyond 3 years here, you can see where that bond yield then remains the same, but investment yields go up, and that's where you have the yield restriction consideration. So really just want to be sure that everyone understands that it's not a set it and forget it. Depending on what happens, you may have outstanding proceeds. You may need to look at this even if your initial investments are below your bond yield. So we really want to be keeping an eye on it on a regular basis for the entirety of your project. Again, the same example, investment yield above the bond yield, even after, or especially after the 3 years. So best practices: provide training or technical support to officials that have to deal with these items. Maintain good records. So working with professionals that are used to these rules and regulations and being able to provide reporting for you is key. Inform your arbitrage rebate firm of changes to an issue. So if you have a refunding, then that will affect your evaluation dates and the calculations. So you want to keep everyone on your team abreast of changes, and also keep your records for at least 3 to 6 years after your bonds are paid in full. So you have records of what happened, maybe not for you, maybe for the next person that's in your seat. And there's a question of what happened and what was done, and was it done the right way? Last piece here, why do you need a paying agent? Number one, it's for protection of bondholders. So the Trust Indenture Act of 39 established these roles, and it's making sure bondholders have a disinterested third party making payments for them and getting them their interest and principal back. Safekeeping of funds, payment and cash flow oversight, again, mitigating risk for bondholders. Your timeline of issuance and paying agent duties. So beforehand, and a lot of paying agents are already working with your underwriter or your financial consultants in advance, but they'll be abreast of what's happening between your deal team and what's in the actual bond documents. At closing, they're going to execute and deliver to purchasers and receive proceeds. Paying agent will oversee bond payments, audit confirmations, and bondholder registration after your closing. So they're making sure that everybody has what they need. So pre-closing, a little more here: document review, comments, establish accounts, and facilitate compliance, partnership with the issuer, and understanding covenant and compliance items. A little bit less for school districts, usually fairly straightforward borrowings, but still another resource that you can use if you have questions. And then at closing, they release the bonds to the underwriter, receive and deposit bond proceeds and establish funds, and disperse cost of issuance and project funds. And then post-closing, some of the other pieces that you don't want to have to do yourself and is much easier to pass on to a paying agent and be able to transition again if it's maybe not you in the seat, but someone who comes after you that wasn't involved in the process. Now you have another resource that's handling these items for you. So they will receive and allocate monthly, quarterly, semi-annual debt service payments. Another major key in the process. If you have the money, but you don't pay your bondholders, nothing matters. So you need to ensure that those payments get made, and having a third party in that role just reduces the amount of potential mistakes that can happen. And on redemptions, they will handle as well, ensure sufficient proceeds are on hand, collecting the bonds for redemptions, and processing notifications. So I'll hit these main points. Potential pitfalls, we've seen this: retirements, vacation, or other change in personnel can result in a missed payment. And that is really the last thing that you want. That's what the whole point of the paying agent and what we're trying to avoid. You can have a ratings downgrade, which then would increase potential borrowing costs in the future. You have to disclose that for 5 years, and it could be a material event that must be disclosed to bondholders and could affect your future status. So we want to make sure that we're staying on top of that. Best practices: get a list of covenant items and due dates if there are items that you need to keep track of, so that you know exactly when you need to handle those. They're a resource, get to know them. And once again, if in doubt, give them a call. Pay close attention to your communication from your paying agent. Those dates are really drop dead dates. So when you need to have the money to them, that's the date that they need the money so that your bondholders get paid. We're slightly over, but I will see if there's any questions in the chat here. Mary asks, can my bank manage my proceeds? Great question. And the short answer is yes, they usually can. The question is, do they just manage the money? Can they also do arbitrage? Can they handle paying agent services? And what options do they have? What rates are they offering to make sure that you're maximizing those funds? So it's possible. A lot of the local banks that we deal with are less inclined to want to collateralize 10 or 20 or $50 million, which is an expense for them, and also pay a great rate on that entire dollar amount, and then know that that's not really going to stick around for the long term. It obviously gets spent down. So short answer, yes. Long answer, may not be the best solution, but it could certainly be a part of the solution. And that's one of the things we do at ADM, is coordinating with local banks as well as our bank partners across the country and securities offerings as well. Another one: how should I figure out how to choose these vendors for proceeds, arbitrage, and paying agent? Excellent choice, or excellent question. And similar to how you've chosen your financial consultant. You can go to a full RFP for these services. You can do a less formal request for information and just gather proposals from different providers. But what we hear the most from our clients is that talking to other districts that are in a similar financial position, maybe a similar type of project, that have worked with these types of vendors, and getting references and referrals from them is usually a really good bet, to know that you're going to get the type of service that you need. They're going to understand the process and understand your requirements. So you can be as formal and detailed as you want, but you know, the hands-on experience of other practitioners holds a lot of weight for the clients that we talk to. So I think that is it. Last call for any other questions. And oh, one more. Do I need to keep my proceeds at the same place, the bank versus an investment manager? Another great question. No, you don't need to keep proceeds at the same place. You could have some at a bank or several banks and use an investment manager. We would typically advise against having too many cooks in the kitchen, so to speak. One local bank where you keep some funds that you have a great relationship with, and one manager that can provide you with some other options is not a big deal, but it can be complicated to just track all those funds, understand where your liquidity is. And so if you have one or two, that's easier to manage. It's also, for arbitrage purposes, easier to collect all the information. So for arbitrage, you need to understand where your money is going out and how much you're earning. So if you have to collect 5 different statements to figure out how much you've earned on your proceeds, it can be time consuming. It can just add complexity to the situation. So, and more difficult to track what you're earning, and if you're getting a good deal. Also, if you have, you know, say 4 local banks that are all paying you a different rate and have different structures. So that's really why we exist at ADM, is to simplify that process. And if there are a few other pieces, we can help coordinate that and consolidate the information so it's in a nice, usable, user-friendly format. Okay, that looks like it for now. So thanks for joining, everyone. Feel free to reach out if you have any questions about your specific issue. We are wishing everyone the best of luck in the upcoming elections, and hope that you will be moving forward with your projects and helping your communities for a long time in the future. Thanks again.